Public submission. Comment from anonymous. Posted by the Internal Revenue Service on September 4th, 2023. Comment ID. IRS 2023-41-5. I'm writing in with comments regarding aligning the treatment of digital assets with the current treatment of traditional financial assets as an individual investor with fairly typical investments in both markets. I have concerns about this proposed rule furthering an existing environment that puts unreasonable burdens on the typical individual investor when it comes to reporting all their transactions. The speed of financial markets has increased exponentially in recent decades, while the fee to conduct individual transactions has dropped close to zero. This is true both in traditional markets, via robo-advisors such as Wealthfront or Betterment, and in digital markets, where newer chains are much faster and have much lower fees than Bitcoin and Ethereum. As a result, it is not uncommon for individual, unsophisticated investors to file tens of thousands of transactions on Form 8949. Sales and other dispositions of capital assets, a form that only contains room for 14 transactions a year. The logistical burdens of collecting, typing out, or printing, and sending in this many copies of Form 8949 is truly astounding when one considers that the net capital gains from 10. Zero robo-advisor transactions could be indistinguishable from zero, as robo-advisors are designed to minimize net capital gains. In the cryptocurrency sphere, where one could similarly record tens of thousands of transactions not only initiated by themselves, but including the round-the-clock actions of others, for example, the use by others of liquidity pools in which one has invested, it is simply unreasonable to expect individuals to collect all this information, because it would take months to do so. It is often impossible to fairly judge the market price of a thinly traded cryptocurrency token at the time of every single transaction. For investors who are committed to fairly reporting and paying tax on their cryptocurrency investments each year, it can be terrifying to put together an individual income filing that one knows to be deficient in this respect, even if one can be perfectly certain that the total sum of capital gains is reported correctly. I would suggest several ways to make this process easier in both traditional and digital finance. First, enable investors who are not reporting enormous positive or negative net capital gains to list the basis, proceeds, and net gain loss from each service on Form 8949, rather than from each transaction. A service could be defined however you see fit: an account, a financial institution, a digital wallet address. This could be allowed for investors under a certain adjusted gross income threshold in order to provide proper scrutiny for those with large amounts of capital gains or losses, minimizing the paperwork burden on the typical investor. Second, consider allowing investors in decentralized digital assets to use a mark-to-market approach to report gains or losses and pay taxes. Digital assets are fundamentally different from traditional assets in one respect. They are not and do not represent cash. While the purchase of a microscopic unit of stock on Betterment involves converting cash to stock cash which could otherwise be withdrawn, purchasing a unit of cryptocurrency on a decentralized exchange never involves fiat currency. It often converts one cryptocurrency to another without going through a currency denominated in dollars. This makes it extremely difficult to understand the cost basis and proceeds of the transaction, and even forces us to simultaneously report the sale of one asset and the purchase of another for a truly unknowable amount of dollars. Instead, investors might have the option of reporting the dollar amount they invested into a digital wallet and their best guess of its current market value at year end, and pay taxes on the difference. You could require them to provide the address of the wallet, use automated tools to double-check what was reported, and even audit the mark-to-market values to prevent abuse. Some investors may not want to pay taxes on unrealized gains, but others would jump at the chance to report their gains and losses so easily. Furthermore, I second the request from other commentators to strongly consider actions, whether in this rule or others, to address the existential threat to our climate that is posed by proof-of-work cryptocurrency networks such as Bitcoin. These networks are single-handedly responsible for more carbon emissions than entire countries, and the US is currently the world's largest emitter of Bitcoin emissions. These networks incentivize a global race for the cheapest and usually dirtiest and least regulated supply of energy, and are blithely unconcerned with their impact on climate change, even as other networks have moved decisively away from proof of work. The IRS has a critical role to play in addressing the harm to the climate and to our collective future that these networks cause. Thank you. Comment from anonymous, posted by the Internal Revenue Service on September 4th, 2023. Comment ID IRS 2023-4015.